All right, why don't we go ahead and get started? So if you'd like to listen to our podcast, you can find Investing Compass on any podcast app, or you can follow us on Instagram, But anyway, thank you guys for joining. So we'll do a little bit of a preview for 2022. Look at what's going on in the market. We're going to reference a report that came out. But first, before we get into all of that, couple of housekeeping items. So number one, I guess, introduction. My name is Mark Lamonica. I look after the individual investor team here in Sydney for Morningstar. And our housekeeping items. So anything you hear today is general advice. I can't offer you personal advice, but I would love some questions. If you're over in New Zealand, you can get a copy of our FAP if you go onto our website, morningstar.com.au. And also the New Zealand regulatory authorities would encourage you to go speak to a financial advisor if you would like personal advice. All right, so as I said, we're going to talk about a forecast for 2022. And what I'm going to do is go through a report that we published late last year. So first, I thought maybe I'll show you guys where to get the full report if you would like. So if you are a premium member or if you take out a free trial, so I've gone to the Stay Informed tab. So I'll go over to Your Money Weekly. And you see here it is, Forecast 2022. So you can go in there, you click download, you get the report in a PDF. You could print it out if you would like. But that's the preview. So that's the report I am talking about. So, all right, let's get this started. So yeah, send through any questions that you have along the way, and we'll see if I can answer any of them. All right, so let's do a brief recap of 2000. Now we're back. Sorry about that. The cord is very sensitive. But it's also, if I ever want to escape, I can just pull it out and run away. But anyway, a brief overcap of 2021. So obviously, coming off of 2020, lots of worries about COVID. Of course, then we have Delta. And because of that and a number of other reasons, monetary policy, and we'll talk about what that means in a second, remained very accommodative. And when we're talking about monetary policy, of course, we are talking about central banks, we are talking about interest rate levels, and then we are talking about non-interest rate manipulations of the money supply, so namely quantitative easing. So quantitative easing is when central banks go out and buy longer term government securities and potentially in some cases, as they did around COVID, around the GFC, non-government securities. So that is buying bonds, that is keeping interest rates low. So we saw a lot of that continue in 2021. Now we saw this happen in the face of rising inflation. So if you read the newspaper, read a lot of business press last year, you probably heard the term transitory a lot. So we did have a spike in inflation globally, kind of particularly in the US. And initially the reaction from central banks was that it is transitory, it's going to be temporary, and is just some supply chain disruptions as the world came out of COVID lockdowns. Well, continued on, most central bankers right now, and we'll get to that on the next slide, most central bankers do not think it is transitory anymore, and now we're talking about rising interest rates. But last year, we did not really see interest rates go up. We saw them in a couple places, including New Zealand, but mostly interest rates stayed low. What we did see is we saw central banks start to walk back their predictions of when interest rates would actually go up. Because we saw inflation go up and because we did not see interest rates move at all, most real interest rates on term deposits, obviously any sort of savings accounts, and a lot of bonds have turned negative. They've turned negative in a real sense. So what that means is that inflation is higher than a lot of the yields that we're getting on fixed interest investments and on cash. The other thing that's happened in 2021 is we saw continued government support. So we talked about monetary policy. This is fiscal policy by government. So governments propping up economies to try to help with any sort of disruptions that we had from COVID-related lockdowns. And we basically, with all of this and everything else going on, we got to a situation where we started using the word TINA a lot. There is no alternative. And what that means is that there is no alternative to investing in shares. So we're getting negative real yields on a lot of fixed interest and cash investments. A lot of investors thought, okay, well, why would I do that? I have no choice but to invest in shares. So we had over here on this chart, and the exhibit numbers on here as we go through, those are actually exhibits in the report. So you go back and reference the report for that. So exhibit 1A, inflow to equities exceeds combined inflow of the past 19 years. So this is a Bank of America study that came out, and actually came out in November. So we weren't quite even done with the year yet. So we'll see where we actually land at the end of the year. But basically, there's been this huge net global inflow into equities. And you can see over $1 trillion. And that compares to the other highs well higher than that. Now, remember, a net inflow, of course, is looking at all the money that flows into equity funds versus all the money that comes out. So people are investing a lot in the share market. Now, historically, these are not good things to see. So you'll see back here, our other giant inflow, second highest inflow into the market. Well, what happened right here? This is the GFC. So, traditionally we do, it's not a great sign to see these large inflows into equities. All right, so what is happening now? Let's take a look at sort of where we are from a current environment standpoint and sort of where we are from a market standpoint. All right, so as I said, most central bankers no longer believe that inflation is transitory. So I know our economists here at Morningstar don't think it will last longer than a couple years, but that's certainly very different from what we were hearing last year. So central banks around the world are now, that what they've done is originally what we heard from the Federal Reserve, what we're still hearing more from the RBA, is that interest rates will not go up for a number of years. They started walking back when they would raise interest rates. Most people now think the Federal Reserve in the US, the US Central Bank, will raise interest rates from 25 basis points to 87.5 basis points. So a basis point is kind of how we measure typically things below a percent. So there's 100 basis points in a percent. So when you hear people say basis points, that's what they're talking about. Remember, 100 in a percent. So this is still historically really low, but potentially this is the start of, maybe if inflation doesn't get under control, could be the start of pretty significant change in the direction of interest rates than what we've had. The other thing that's happening, so interest rates, when we think about central banks, so central banks control generally what they did until the GFC really is that they would control short-term interest rates, and they do that through what they call open market operations. That's the buying and selling of very short-term government securities. And as I said before, they embarked after the GFC on something called quantitative easing. So quantitative easing is buying longer-term government securities and potentially non-government securities, so mortgage-backed securities during the GFC and some corporates during the original sort of COVID scare. And what has happened is these central banks have built up these huge balance sheets. So they buy all these securities just like any other bank. They're holding all these bonds. So tapering is a word that you'll hear a lot. And basically tapering is how a central bank, particularly the Federal Reserve, starts to, in a controlled way, lowering the amount of securities that they're purchasing. So we've heard that the Federal Reserve started that in November. So that is also going to have an impact on interest rates. So let's see, that's a meeting of the Federal Open Market Committee. The Federal Open is not like a tennis tournament. I just didn't put that in. All right, so let's talk about where the market is right now. And I've characterized it as a market priced for perfection. So there's obviously a lot of arguments we can make around looking at different valuation metrics and everything else. But in general, the market is priced. The stock market is as priced from a valuation standpoint as high as it's been in the last 70 years. So there have been very few other times where it has been priced at the level it is now. So when we say valuations, what we're talking about is how much is an investor willing to pay for earnings. One of the things that really impacts that is, of course, interest rate levels. So we'll talk about this a lot today as we're going through. The lower that interest rates are, generally the higher the valuation levels are for equities, because the way that we value a share, and if anyone's tuned into these webinars before where I talked about valuing a share, we'll talk about this today, we estimate out cash flows in the future, we discount them back to the present day. Level of interest rates are a big factor in what we discount them. So lower interest rates means we are discounting those cash flows less, which means equities are worth more. So these two things combine, but of course, bond yields, as low as they've been in 70 years, that also obviously isn't great for a lot of investors, particularly investors who are trying to lower the volatility in their portfolio. They're just not getting a lot of returns. So remember, if you're a bond investor, and this goes back to that Tina, that there is no alternative. If you are a bond investor, the sources of return are you get, of course, interest paid. You're getting next to nothing now. And then bond prices move inversely to interest rates. So what that means is that when interest rates go down, bond prices go up. So that's another source of return. If interest rates are very, very low, and everyone expects them to go up and continue to go up, it's not a great time to invest in bonds. So once again, there is no alternative. The other thing we need to look at is the yield curve. So the yield curve is flattening. So let's spend a second talking about the yield curve. So the yield curve is the difference. So if you think about literally a yield curve, is the different interest rates that you get based on different maturities. So what that means is if I buy a bond for 3 months, I get a certain interest rate. If I buy a bond for 10 years or 30 years, I also get a certain interest rate. Normally, a yield curve will be sloping upwards, right? That I would expect to get more interest to go out there and lend my money to somebody for 10 years than I would if I lend it to them for 3 months. And that makes sense, right? You're locking up your money for 10 years. You have to deal with credit risk for 10 years. A lot easier to predict if someone will pay you back in 3 months than what the shape they'll be in 10 years. So when we talk about a yield curve, normally that is a normal yield curve. You get more interest the longer you lend your money, the longer the maturity date of those bonds. Well, yield curve's starting to flatten. So since late February, last year, obviously, the yield curve between the 5-year and the 30-year bond in the US has contracted 102 basis points. That's a little over 1%. Remember, there's 100 basis points in 1%. So it's gone from 162, so 1.62%, to 60 basis points, so 0.6%. So a pretty significant drop. The reason we're interested in this is yield curves that invert. So a yield curve that inverts means that we're getting less interest for a longer dated bond than we are for a short dated bond. That is generally the sign that we are in a recession, or we're about to go into a recession, because investors are obviously very wary about the current economic environment. So something to look at there. The other thing that we need to look at, and we'll talk about a little bit today, is that since the GFC, we have had really what we'll call a momentum-driven market environment. So basically, very few shares and certain sectors have done very well. And in a market cap, and we'll get to this on the next slides, in a market cap weighted index, that means they make up more and more of the index. So we haven't seen any sort of rotations. Generally, if you wanted to invest since the GFC, large cap growth particularly technology and some communication services stocks, have done very, very well in the US. And that's where you wanted to invest. And so what we've seen is that indexes have become more and more concentrated. So concentrated in certain sectors and then concentrated in certain company names. So we see this seemingly every 6 months, Apple's valuation goes up $1 trillion, right? So, famously, Apple hit $3 trillion and retreated a little bit, but a couple of weeks ago, it hit $3 trillion. So you're seeing these giant companies, giant in terms of how much they're worth, taking up more and more of the index. So that has implications on index investors. Even if you're not investing in direct shares, even if you're not doing anything but just taking a step back and being a passive investor, you do need to worry about this concentration and do need to worry about what would drive an index down. So it's these same names, right? So stocks like Apple and Microsoft and Google and Facebook in the US. In Australia, and we'll get to Australia as well, think miners. So particularly BHP, now that they've delisted in London, when they come back fully into Australia, they will make up a huge percentage of the index. So do the banks, so does CSL. So it's important as an index investor to know what index you're investing in and what's going on with it. The other thing that, of course, is happening that I didn't put on this slide, particularly relevant to Australia, is a lot of stuff's going on in China. So obviously, I think most people have probably heard about the different trade tensions that have occurred. But the other thing is the Chinese are trying to remake their economy. So they're trying to, and for years, right, the approach in China is anytime there was a slowdown in the economy, that they would just borrow a bunch of money and build a bunch of stuff. So this sort of debt financed infrastructure spending was sort of the Chinese approach to everything, right? The government was very worried that the economic growth rates fell, that there would be unrest, which would impact the Communist Party and their grip on power. So they just borrowed a bunch of money and built a bunch of stuff. And we've seen this with property developers recently, right, in China. Well, the Chinese realized that this is unsustainable, and they came out and they're going to have another meeting in March to develop another 5-year plan. And basically what they want to do is they want to boost domestic consumption. Like most Western economies are driven by domestic consumption. So they want to boost consumption by people in China and stop having these large scale infrastructure projects. So of course, the problem in Australia with that is where do they get all the materials for these large scale infrastructure projects? A lot of it is iron ore from Australia as well as other commodities. So anyway, that's a little bit of a preview. We've got some questions. You are right, anonymous attendee. Sorry, the GFC was 2008. Not 2018. So let me go back to, oh, there we go. You are right. Sorry about that. That is my fault. Yeah, so we've got a question from Ash. So Ash is saying, with forecasts of oil reaching $100 a barrel, if this were to occur, would this push up core inflation? Thus, the Fed would raise interest rates even further to mitigate this. Yeah. So, what we need to do when we think about inflation. So inflation is measured by the consumer price index. So basically, yeah, it's a basket of anyone who's on the webinar earlier today. We talked about this. It's a basket of goods and services that people buy. So you can go directly see how much energy makes up of that. But yes, one of the big influences inflation so far has been pretty steep rise in energy prices. So yeah, energy prices certainly would drive inflation higher if they continue to go up. Yep, a couple of people told me about my mistake around the GFC. Yep. Go. Okay. I will get to the other questions as we go through this. I will not ignore them. All right. So I wanted to look at two different things to sort of look at where we are. All right. So I put together a slide. I'll show you where you can do something similar. So just looking at the Aussie market. So all markets are divided up into sectors. So sectors are basically companies that have similar characteristics. And they operate in similar characteristics. So we'll say that. So we've got sectors and we have industries underneath it. So these are the different sectors in the market. And those sectors are, as we go through each sector, we'll talk about this. They can be classified, and what we classify them at Morningstar, but pretty similar to how everyone else does, sort of three categories. So we've got cyclical, we've got sensitive, and we've got defensive. So all three of those categories are just looking at how these sectors generally react to changes in the economic cycle. All right, so to use two very simple examples, a cyclical sector is something that as the economic cycle goes from boom to bust, that we will see these companies doing very well when the economy is doing well, and then not so well when the economy is not doing well. A defensive sector or defensive company would less be influenced by that economic cycle. So very brief description, we'll look at basic materials. So basic materials is a huge part of the ASX, which we'll talk about in a second. So basic materials, at the end of the day, is really inputs into construction. So if you think about iron ore, so iron ore is obviously used to create steel. Steel goes into new construction. So construction generally follows the economic cycle. So as economies are sort of heating up and doing well, people go out and invest and they build things. We go and we look at healthcare. So healthcare is defensive. Why is it defensive? Because no matter what's happening in the economy, you're probably just going to go to the doctor and seek medical attention if you need it. So that would be less influenced by the economic cycle. So yeah, just something to think about as we go through these. But what I wanted to put in, I went and I looked at the ASX 300 and looked at the percentage that each one of these sectors makes up. And so why is this important? It's important because I know a lot of people invest passively. They're not out there trying to find individual shares. So it's important to think about what are the differences between global stock markets. And we can think about then where we are from an economic standpoint, how that might be influenced. So you can see Australia is dominated by basic materials, and that will go up when BHP becomes just listed in Australia. And of course, the banks. So we can sort of think about how these different sectors, look. We can go back. We look at 5-year performance. I'll show you guys how to do this on different markets in a second. You can see that obviously the miners have done very well with iron ore's price spike in the last couple of years and then decline. But you can see what has done well and what has not compared to an average. I will say that that average is very good historically over 5 years. And then the other thing you can look at is current valuation. So let me spend a second on this. So our analysts cover shares, and we'll go through what they do, but what they're doing is they're calculating a fair value. And then what we do is we compare that fair value to a price. So very simply, if our analysts believe that a share is worth $100, so when they are creating their models and estimating out those future cash flows, discounting back to the present day, they believe a company is worth $100 and it's trading for $50. So what does that mean? It means it's undervalued. That would be a price to fair value, a current valuation of 0.5. So basically what these numbers mean is how overvalued or undervalued our analysts believe a certain sector is. So 1.08 means that we believe it's 8% overvalued. Whereas 0.69 in the energy sector, we believe that it's 31% undervalued. So just wanted to give a little bit of a scan of sort of where we think the market is overall. So if we look at Australia, a little over 5% value. Now, one important caveat to this is that all of these numbers right here are equal weighted. So what that means is, unlike an index where the bigger companies count for more, we are just looking at this equal. So if there are 10 companies in basic materials, and BHP we think is way overvalued. I'm not saying we do, but if we thought BHP was way overvalued, then in a market cap weighted index, I would drag that number up. But in this case, we just average those 10 out. This is something to think about. And quickly, same thing for the US. The US in particular, as I said, large cap growth shares have done very well, particularly technology. So you can see technology makes up a really big part of the S&P 500. So just remember that if you are a passive investor, you're buying the S&P 500, just know what you are buying. Quarter of it is technology. Whereas we go to Australia, Australia doesn't have as much technology, tiny bit is technology, right? You're buying financial services. So it's just important to remember what you are buying as an investor. You can see the 5-year performance has been significantly better than Australia, particularly in the technology space. So some of these numbers are historically very, very high. And then once again, you can see Morningstar's valuation. So one thing we did have a question on here asking about Europe and Japan. So are Europe and Japan, would they be safe havens in this environment? I'll say one thing that both, Europe and Japan, when we compare certainly to the US, have not done as well. So if you want to see what we think about those two markets, so on back my page, if you go to monitor markets, you select your market. So let's say, we wanted to do Japan. So go into Asia. So the first thing you can do is you can see our valuations in each one of the markets. So these are overall. So in this case, we think Japan is 8% undervalued. So that's fair value, 0.92. The other thing that you can do is look at the sectors. So depending upon what time frame you want to use, you can look at the performance of each one of the sectors, in this case in Japan, and you can also look at the valuation levels of each one of those sectors. So it is a tool where you can go in there and look for, are there areas, you can see the current price to fair value and a year ago, are there areas of value? And then of course, I will say, obviously you can go and invest in any sort of fund that's looking at Japan or Europe, but you can also, if you want to look at individual, we don't cover a ton of companies, 58 in Japan, you can go look at all the companies we cover. So just wanted to show that. So hopefully that's helpful for everyone. Now we'll go back to sharing the other screen. I'm doing very well in the new year of switching back and forth between screens. I'm going to give myself credit for that. All right, so what I thought would be helpful is to go sector by sector. Now I'm going to go at a high level. So this report, just in the interest of time, so this report that was put out goes sector by sector. The sectors were really looking at Aussie shares. But what I did is I included also US shares if there was something interesting in there. And what I got these from, see if I can keep up my switching screen magic, is our global best ideas. So basically we went through every sector and I looked in to see if there were global best ideas. So our global best ideas is a list that our analyst puts out every single month. And it includes, as the name would suggest, all of their best ideas. And so what I did is I went through and pulled out some names based on these sectors. So this is obviously just things I pulled out that I thought would potentially be interesting. So you can see we've got the countries with Australia on top. We can also sort, which is what I did. You can sort by sector. So if you want to look at basic materials, you can see some shares in the US, which will be on this slide. So I didn't pull them all out, but people can do that if they would like. All right, we seem to have a lot of questions. So before we get into sectors, let's go through a couple questions. All right, so we've got a question from Graham saying, with inflation in the US around 4 to 5%, and even like some of the more recent readings higher, is this expected or anticipated to flow onto Australia and New Zealand? So yeah, the interesting thing about New Zealand is, right, the central bank in New Zealand's already started raising interest rates. What I would say is, kind of one of the issues with inflation, one of the reasons why central banks, of course, want to always talk it down, is inflation. Once people decide that there is inflation, that tends to fuel it, right? So if we think about, as you start to see goods going up, what are you going to do as somebody who is still working? You're going to go to your employer and demand more money. If employees start getting paid more, then the price of goods and services has to go up. And so inflation can spiral upwards. So yeah, it'll be interesting to see what happens in Australia. Australia so far has been behind the US, but we'll see. We're obviously seeing some of those same supply chain issues that we've had in the US. Obviously, sort of global energy prices and things like that affect Australia as well. Question will be, are we going to start to see wage inflation because the border pretty much remains closed, right? Without sort of skilled migration and without migration like backpackers coming in. We've all seen these stories about people getting paid $90 an hour to wash dishes because restaurants can't find any staff. I think that could be a potential source, but yeah, we'll see. Obviously, it's hard for me to predict, but think about those drivers of inflation. So yeah, I think we're starting to see some in Australia as well. All right, so Bill's saying quality is also taking a hammering at the moment. Are income funds the only refuge? Yeah, I mean, a lot of times, I would say that we would kind of equate an income fund in some ways with quality, right? So generally, when we're talking about quality, what we're talking about is shares, companies that meet certain attributes. So one attribute we obviously hear a lot with quality is we want to look at financial strength. So financial strength, we want to look at balance sheets of companies, make sure that they are in good financial shape. Peter Warnes talks all the time about sort of zombie companies that really are just sort of perpetually rolling over debt and not actually making any true profits. So that's an example of not quality. The other things we look at in quality is we look at sort of variations of earnings. Or have earnings been pretty steady? Are they bouncing around a ton? So income is generally something that people would look at as well. Yeah, I mean, Bill, obviously, I don't know. I can't predict the future. I think, income is always attractive because generally shares that pay high dividends have less volatility. Just because people are hanging on to them for those dividends versus a more speculative share that does not pay a dividend. You can see a lot of volatility bouncing around. So Bill's asking, what did your economist say would take 2 years? So basically what they've done is when they've started looking at inflation, they think that a lot of these supply chain disruptions that came out of COVID would take 2 years to clear at least. So this is kind of what a lot of economists are saying is originally they thought this was going to be very short disruption that would go away. We've obviously heard about all this stuff, microchips going into cars and preventing cars from being manufactured, all of this stuff that sort of built up with all of the disruptions to the global economy around COVID. They thought it was going to happen very quickly. Now economists are starting to walk it out. So I'm just saying that our economists are saying, yeah, it'd take 2 years for some of this to clear. So we've got a question. Do you see house prices going down with an increase of interest rates? Yeah, I mean, listen, house prices are interesting, and I always try to keep myself from getting in trouble by saying anything negative about them in Australia. Yeah, at a certain level of interest rates, house prices will come down. I think there are lots of factors that obviously go into housing. So certainly net migration is a huge part of housing that influence housing. But affordability matters as well, and affordability is driven by interest rates. So obviously, if you show up at the bank and you ask them, here's my salary, here's how much I've saved, what can I afford? That interest rate level will matter. So at a certain level, interest rates would drive down housing. There's also obviously all sorts of other things that will influence housing. So number one, I think, our friends over in New Zealand certainly have seen this, that regulation by the government. So whether it's directly by the government, whether it's by a regulatory authority on the size of loans or restrictions around loans, that will influence housing. That's basically doing the same thing that interest rates are doing. So yeah, there's all sorts of things. And obviously on the plus side, certainly any sort of tax policy or the ability that what we've seen is to pull money out of other sources to go into the housing markets, just taking money out of super to buy a house, and sort of easing some of those restrictions, that would obviously be on the plus side. So yeah, it's hard to tell. So the anonymous attendee says the forecast increase in interest rates is 0.875. Is that per annum? It is, but basically what that is that's the Fed fund rate. So basically what we're looking at there is kind of the overnight rate that a central bank would lend to a bank. That doesn't mean you're going to get that interest rate, right? There's a lot of things that happen after that, but the risk-free rate or the Fed funds rate will affect basically the risk-free rate, which is government bond yield. And then, lots of different things are priced on top of that. So we'll get to it when we start talking about banks, but obviously banks are very, very interested in the net interest margin. So what is the difference between what they can source funds from? So that could be borrowing from a central bank, but often, particularly in Australia, it's from depositors. And then what they can lend money for. So banks tend to do pretty well in rising interest rate environments because they will generally increase the price of their loan. They'll increase the interest rate on loans before they'll pay depositors more money. So there's generally a lag. So that net interest margin generally increases during interest rates rises. And we've seen, I'll just skip to this since we have a question. We'll get to this in a second. So what we've seen is we've got this chart when we look at financial services that the net interest rate margin, so these are obviously estimates out into future years, has been coming down. So it's been coming down as loans have been repriced into a lower environment. So Nathan, our banking analyst, does not believe it'll start going up until the RBA starts raising interest rates. So the RBA is kind of holding off a little bit. Well, we'll see what actually happens, but has not talked about raising interest rates as quickly as the Federal Reserve in the US. So that's sort of what we're worried about there. All right. So Eric is asking, do you think the great rotation of value stocks will take form this year against the backdrop of a more contractionary economic environment in the US? Which key sectors would we as investors look at? Okay, so first, before I attempt to answer Eric's question, let's talk about what's happened. So we have growth in value stocks. So all we're doing with growth in value stocks is looking at all the shares in the market and dividing them up by valuation measures. So we'd look at price to earnings. So how much is an investor willing to pay for a dollar of earnings? Price to book, price to cash flow. There's all sorts of different ways we can divide this up, but more expensive shares go into the growth category. Less expensive shares go into the value category. Now, why as an investor would you pay more for a dollar of earnings? You would generally do that because earnings will grow faster in the future. You expect earnings to grow faster in the future. So I don't care if I pay, making this up, if I pay $20 so I pay a P of 20, so I'm paying $20 for a dollar of earnings. I don't care if I do that if I think earnings next year will be $2, right? So that means if I look at a forward P, I'm essentially paying 10. So that's kind of how we divide up growth and value. Now, what has happened since the GFC in 2008? What's happened since the GFC is we have had we basically, growth stocks have done very well and value's done very poorly. Now, growth stocks tend to fall in certain sectors, and they tend to fall obviously in the sectors that are growing faster. So technology is a perfect example. Technology is a growth sector generally. Doesn't have to be, but it essentially is. So technology is a growth sector. Technology shares have continued to do very, very, very well. Value is done very, very poorly. So value sectors are generally financial services, energy, consumer defensive. I mean, consumer defensive is kind of, I guess, balanced most of the time. But yeah, those sectors have done very, very poorly. So everyone keeps talking about when will this rotation into value happen? And if you go back and look at what's happened in the market, particularly kind of the last quarter of last year and the last couple of days as well, is that growth stocks have done very poorly. So particularly technology shares have done very, very poorly. And there's potentially a lot of reasons for this, but a big one is that as the market anticipates increasing interest rates, what that will do is that will hit the valuation of growth shares instead of value, because once again, when we're estimating out cash flows into the future, the more of the growth that's way out in the future, the bigger the impact of higher interest rates going into models. Now, we obviously don't know any of the reasons for sure, but that is true, and people think that that is influencing what's happening with growth shares. So the big question is, will we see a rotation back? Well, yeah, I mean, obviously it's anybody's guess. There have been people that have sort of called this rotation back to value for a while now. I will say that, there's a lot in the current environment that if you go back and look at the dot-com crash, to me, there's a lot of similarities. There's a lot of speculation out there. There's a lot of people buying things without even really considering the value of them. And this is obviously, as I would be made fun of by the younger members of my team, maybe this is an old man speaking, but if you start to look at some of the cryptocurrencies, start to look at NFTs, if you start to look at the valuation of certain shares, there seems to be a lot of speculation out there with those inflows into equities, with option activity going way up, with margin lending going way up. There seem to be a lot of similarities. So what happened during that dot-com crash? So we did see a huge rotation back into value, and value stocks actually did pretty well. So if you go back and look at what happened in that crash and look out a couple of years, value actually did really well. So there are a lot of people. So Eric, I obviously can't predict the future. There are a lot of people, including me, saying the environment looks similar. And what did happen back then is we did see a rotation back into value. So I think there will be at some point. The question is, when is it? Okay, so Kim's saying, if Russia invaded the Ukraine, they said today or yesterday they weren't going to do it, though. So doesn't everyone believe Putin? Or China invaded Taiwan, which is my birthplace. How much do you think the ASX would drop? Yeah, it's something that Peter Warren's pointed out in this report is that, geopolitical tensions have risen. So, listen, I can't predict what would happen in either one of those situations. I think the Biden administration's obviously come out and sort of outlined what they would do if Russia invaded the Ukraine, which is namely around sanctions. I think the bigger wild card is China invading Taiwan. If that happens, the question is would the U.S. go to war against China? That obviously would not be great for the market. All right. So the anonymous attendee says U.S. tech does not look expensive according to these numbers. Agree. I would say, okay. So what I would say, so you're referring to these numbers. Okay. So there's one thing, and I should have pointed this out. So number one, these numbers are obviously are skewed by the fact that we are doing a equal weighted calculation. But the other thing I would say is that we don't cover a lot of the very speculative tech stocks. So we, as a company, cover 1,600 stocks globally. These are only shares that our analysts cover. So I think that there's a lot of froth in the technology space in sort of companies that we don't cover. So more speculative companies. The question is kind of what that knock-on effect would be. So if we've looked at stuff that's happened in the NASDAQ, even the past couple of days, it hasn't been great. I would agree that these numbers, if you're investing in individual shares, I would go in and obviously look at the individual shares, what our analysts have to say, and do your own research. This is not that high. So 6% overvalued. What I would say also is, and we'll go through a couple examples of this, don't think that the market would stop at one. Number one, obviously, these are analysts predicting the future. But generally what we see is pretty wide swings. So maybe a good thing to share is, I think I can actually only go back 10 years, but let me show you, I'll show you a chart of the US. All right, so I can only go back 10 years. So I wish this thing went back further. But what I would say is, these things are going to potentially fluctuate pretty significantly. You can see, so here's sort of the COVID drop. right? So got down to, in our case, like looks about 0.82, so maybe 18% undervalued. So obviously a pretty good time to buy, but just know that there are swings. Like one does not mean anything is going to stop. So be careful about that. And it's obviously just what our analysts think. Okay, a good question so let's do some questions for a while, if that's cool with everybody. I'll obviously stick around. What is the difference between quantitative analysis and qualitative analysis? The fair value differs significantly. Okay, let me talk a little bit. I'll just take you into the world of Morningstar ratings. Okay, so a qualitative analysis that we have, and that's really what you're getting on premium on all the shares, is something that's done by our analysts. So there's a human that sits down, covers that share, estimates out cash flows, learns about the company. We believe in fundamental analysis, comes up with a fair value estimate. That is qualitative analysis. We also have quantitative analysis. So basically a computer does it, an algorithm does it. Now, and something that drives me crazy as the person who runs our individual investor business here, we have sold our quantitative analysis to a lot of brokers. So if you go to a lot of brokers and look, they will tell you a quantitative analysis, which if we cover the share could be very different from what our analysts think. So personally, I would look at the qualitative analysis, but yes, it's something that annoys me, Sadhana, but such is life. All right. Okay, so Madonna is asking, how do you determine what stock sits under each sector category? So it's not something Morningstar does. So that is something that is universal. All shares fall into a sector. It's not a Morningstar thing. What basically is happening is companies that have similar attributes are grouped together. Now, there's some weird stuff in there once you start learning a little bit about the sectors. For example, like Google, Facebook, or Meta, or whatever it is now, Alphabet and Meta. So now they're coming up with new names. Both of those sit in communication services. Most people think they were in tech. But they are classified, like there is an industry body that classifies them. So Morningstar doesn't do that. We just show what something is, where something is. Okay, the anonymous attendees say, with 4 interest rate hikes in the US, making it a 1% hike in total, thereby increasing the discount rate by 1%, all being equal, what percent decline in fair value can we see in general? All right, so we can't actually, it's not that clean of a process. It's not that clean of a process for a couple different times. So what the question is asking, so remember, when we value a share, we are estimating, our analyst is predicting the future, estimating how much the company will make, and then we take that and we discount it back to the present day, right? Because $1 today is worth $1 in the future. What we discount that back using is the weighted average cost of capital. So that is not simply a interest rate set by a central bank. It is the company's interest rate. So in the case of the company borrowing, we would go out there and look at what they're actually borrowing for. Now, as risk-free rates go up, all rates in theory go up, but how far they go up based on credit quality of the company, all sorts of different factors would differ. So it's just not that clean. So basically, as interest rates go up, like all debt in theory will reprice, right? That's when bond prices move. So if we think about what happens is, as I said, bond prices move inversely to interest rates. So if interest rates go up, bond prices go down, which is essentially just repricing that bond at a new interest rate, right? At a higher interest rate. So hopefully that makes sense. So yeah, it's not that clean to say that we can just calculate what we'd see in general. The other thing is, of course, analysts all have different models, right? If we think about the price of a share, and the price of the share is not just driven by what analysts think it's worth. Think about the price of the share. That is the consensus of the market in a given moment, when you get a quote, in a given moment on how much something is worth. Now, what drives that? There are all sorts of different things that drive that. So it can be, very rational share analysts. It could be day traders. It could be someone who's just investing for the first time and shoving money into an index fund. All sorts of things can influence a share price. So yeah, it's not that clean, unfortunately. And interest rates also, the other thing it's important to remember is interest rates will have impacts on all sorts of different things with the company, right? So if we think about banks, we think about an environment where a net interest margin is actually improving for a bank. So that means that, yeah, we may be discounting those future bank earnings back by a different amount, but those earnings may be higher, right? Because they would be influenced by interest rates. The opposite might happen for other companies where interest rate changing might influence how the company does. So it's unfortunately not that clean. Okay, so Michael's asking, thematic. Can you explain thematic? Okay, so anyone who's listened to our podcast knows that I have some feelings on thematic. Okay, so thematic can mean basically almost anything, but how it's generally meant is that okay, I'll come up with a cynical point of view, and then you guys can, and then I'll go into a non-cynical point of view. That, at the end of the day, companies that are selling products, so financial services companies that are selling products, selling ETFs, for example, want as much cash to move into those ETFs as possible, right? The way they make money is they take a percentage, right? We all see the expense percentage on an ETF. If it's 50 basis points or 0.5%, they want more money because they'll make more money off of $200 million in that ETF than $100 million in the ETF. And so what I think a lot of these thematic ETFs, I believe, are marketing gimmicks set up by ETF providers traditionally. So what they'll do is they will find something that the market in general, that the population in general believe is going to happen. So they will say, okay, there are going to be more electric vehicles on the road, right? So that means that there are more batteries, and battery technology is really important. So then they'll come up with an ETF like ACDC, right? And basically the way that they come up with these ETFs is they shop around. An index provider will create an index. That index, the ETF will then track that index. So it will track a certain theme. So what it's supposed to do is it's supposed to give you exposure to something, in that case, battery technology, or there is, it's been a disaster for investors. There's this new crypto ETF, right, that was introduced that's looking at companies that support the infrastructure of cryptocurrency that has subsequently gone down significantly in value. So those are themes. And the themes are supposed to get investors' attention. The concern that I have over thematic ETFs is that a lot of these themes, number one, are introduced after there's already consensus that this is a good thing. So you're sort of chasing in the top, and these things have done very well, but you're sort of getting in late, because once everybody thinks something is great, then that's already priced into all of these shares and all of these companies. So that's a concern that I have with themes. The other thing is that a lot of these thematic ETFs, if you dig under the hood a little bit, don't necessarily follow that theme. Like if you look at ACDC, for example, go look at the companies that are held in there. A lot of them are sort of traditional industrial companies that do have a battery technology side to them, but most of the revenue doesn't come from battery technology. So you're investing in, actually, the interesting thing about ACDC, if you go and look at, I don't mean to pick on it because there are worse ones, but if you go and look at the companies you're actually investing in, a lot of them are old school industrial companies. And yes, they are using battery technology, and yes, they are manufacturing batteries, but it's not that big of a part of their revenue. So those are some things that I guess thematic that I'm concerned about. But yeah, think of it as people like investing in themes, right? But just realize that that theme is not necessarily going to be profitable as an investor, because it all depends upon depends upon what price you get in. So hopefully that explained it, Michael. But yeah, that's really what people are talking about with thematics. This idea that you identify something happening in the world, and that eventually translates into a good investment. Just realize that by the time an ETF is released in that, it has been identified and probably invested in by a lot of the earlier, smarter money, and you're just sort of chasing the end, potentially. All right, so Polly is saying, will there be a big correction in the market in 2022? I have no idea. Unfortunately, I cannot predict the future. Like, listen, I would say, I think that there are some unsettling things in the market right now. But obviously I have no idea. I have no idea where the market's going to go. The one thing that I will say is that when we've had years and years and years of historically above average returns, we just need to be careful. We need to be careful because to get back to average, what do we need, right? Mathematically, we need below average returns. It doesn't mean the market's going to crash, but at some point, unless the market is permanently going to start having above average returns forever, that average is significantly higher, right? When I go back and look at the US and I see that 18% returns over the past 5 years, that's a lot higher than sort of the 10% that we've gotten in the last 120 years. So when I go back and look at that, I think, okay, well, at some point to get back to that 10% average, right, we're going to need to see lower returns. But yeah, I don't know what's going to happen. Okay, so Scott's asking about FANG stock. So I assume that you're not asking about the ETF, another thematic ETF. You are looking at Facebook and Alphabet, Netflix, and Google. Are they growth and value? So it's interesting. If you look at some of these large tech companies, the valuations aren't that out of line. What I would say is, technology shares have done very well for a number of reasons, right? If we kind of look at what's happened with technology, technology, and one of the reasons that people like technology shares because they're all great companies, right? They're all very, very scalable. So meaning that with a small employee base, with not many assets, they can make a lot of money. They have very high margins. Those margins tend to expand when they grow. So if we're talking about margins, we're talking about the difference between revenue and profits. Those margins expand as they get bigger. And the reason for that is pretty simple, right? Like if you are Microsoft, and I'm being very simplistic about Microsoft's business model, if you're Microsoft and you've got 10 guys in a room on a computer creating a new version of Windows or whatever we're on now, creating new software, and you sell it to 1 million different people, all right, great, you'll make some money. You sell it to 1 billion different people, well, you still got those 10 guys in there designing it. Now, obviously, I'm being a little bit, I'm exaggerating a little bit how these business models work, but that's very different than what companies used to be, right? Like think of an industrial company with a factory. I build a factory, I create a bunch of shoes, I go out and sell them, and everyone loves my shoes. Well, what do I need to do to meet demand? I have to go build another factory, right? So that is very expensive. So I need to go out there and invest all that capital. Technology companies generally just scale, just like Facebook, right? Facebook, yes, there are some more expenses, but if you have 1 billion people on the platform versus 100 million people on the platform, like isn't a huge difference. So that's why people really like these technology companies. I think kind of the biggest risk to a lot of these is probably regulatory at this point. So whether that's true regulation or backlash from people, that's kind of where I would look out for some of those. So yeah, and so yeah, somebody's asking like, what do you think if we rotate back to value, what do you think the effect would be in the FANGs? Yeah, so Chris is asking that sort of same thing, right? So if it is a rotation back to value, yeah, I mean, probably not going to do great. But if you look at a lot of them, our analysts think pretty highly of a lot of them. All right, so Eric's asking a question that I'm not going to be able to answer. So, what are your top 5 picks for 2022? Are they more concentrated in one sector or the other? Okay, so what I would say, if we talk about Morningstar, right? We don't even talk about me personally. We're talking about Morningstar. What I would do is I would go look at that best ideas list. That's really where you'll see our top picks from around the world by our analysts. And what I would say, like, if I want to talk about, kind of personal, and I'm not going to obviously share any of my specific thoughts because no one wants to hear those. But if I want to talk about personal, what I think that people just need to be careful about is making sure that they invest in shares that are right for them. So what I mean by that is, personally, what I'm comfortable in is more conservative. That doesn't necessarily mean value shares, but I'm personally interested in investing in companies that generate reliable cash flow, that pay high dividends, that are financially sound. And that just sort of moves me into certain categories, right? So I'm naturally not going to go invest in some lithium mine that's in a ton of debt and is pretty speculative and is going to have cash flows bounce around a lot. That doesn't mean it's a good or bad investment. It's what's good for me. And what I think everyone needs to think about when they're investing things is what is going to prevent you from doing something stupid. And what that stupid thing is selling or buying at the wrong time. And so, I wouldn't personally, with my personality and everything else, wouldn't react very well to huge swings in price. Right. So that's just personally what I'm comfortable in. And I think, I want to put myself in a situation where I don't do something dumb and I don't throw all my money into something at the top of the market. I don't sell and panic at the bottom. So that's the only thing that I'll add, Eric. That report. If you're not a premium subscriber, you can sign up for it. Also, if you want one, just send me an email, mark.lamonica1@morningstar.com, and I can flip it to you. But yeah, I'll go through these sectors somewhat fast. So what I've done is I basically just looked at, pulled a couple snippets from this report, looked at a couple different securities. So basic material. So very simply, as we talked about, they are generally companies that supply most of the inputs that go into construction. So whether that's mining a commodity, as we said with the iron ore example, that's a good example. And so if we think about Australia, once again, these snippets are pretty based on Australia. A lot of, so something like 60%, I think, of BHP's profits come from China. A lot of the demand, of course, comes from China. We believe, as I talked about, we as Morningstar believe that a lot of this commodity demand will soften for a number of different reasons. One, China is getting a little more serious about carbon emissions. There's obviously these trade constraints. We've had these issues with property developers, and then issues in general or indications in general, the Chinese government wants to move away from this debt-fueled infrastructure spend. Iron ore has come down a lot. So, it was around $220 at the peak last year. We think over the next couple of years, it's going to be around $116 a ton. So we saw a pretty big pullback from miners. They've recovered a little bit, but they're kind of floating around fair value. So the two companies I took are both US companies off that best ideas list, just because we don't have any that are in Australia. So I don't know if people have heard of Compass. Probably not. So Compass basically, it does a couple different things. Salt. So they create salt. Mine salt that's generally used to ice roads or to de-ice roads in colder climates. And then they create specialty fertilizers that are obviously used on crops. They're moving into a couple different markets, including one that people will probably be very excited about, is moving into lithium. So it turns out that when they make this fertilizer that they sell, a byproduct that you can create out of it is lithium. So everyone loves lithium because lithium is an ingredient that goes into batteries. So they're moving to that. And they're also moving into a product that is used to combat forest fires or bush fires, right? So a fire retardant. So now they've got sort of both ends of the spectrum, right? Fire and snow. So yeah, we think they have a wide moat. So, which means we think they have a sustainable competitive advantage. And you can see it's trading at a pretty big discount to our fair values. That's a US stock. And then DuPont is as well. But you can read about that in our best ideas. All right, we'll move on to communication services. So basically what we're looking at is fixed and wireless telecom here. So, you know, there's a couple, one local company that I put on here, Southern Cross Media. So Southern Cross Media is a radio station that we have on here that our analysts like. So you can go and read about why we like Southern Cross Media. A couple of things to note. Well, number one, it doesn't have a moat. So when you're looking at companies, when you're thinking about what company is right for you, so a sustainable competitive advantage is something that over time will accrue to shareholders, we believe, through a higher return on invested capital. So you're investing the money that the company is investing, you're earning higher returns on that and higher margin because they're able to hold competitors at bay. I can obviously go through a very long moat description, but I'll leave it at that. Uncertainty rating, just as you're learning to read our ratings, an uncertainty rating refers to, our analysts, of course, are predicting the future here. Future is unknowable. So they are looking at what are the different things in that industry and that company that give them a high degree of certainty or a low degree of certainty in those earnings projections. So a very simple example that I'll use is companies that are high in debt, companies that are in industries where they're price takers. So they have very little control over pricing. So like a commodity company would be that example, right? Like there are things a company can do to try to control commodity prices, namely cut production. That's not great for shareholders, but price takers just take whatever price is out there. That would all increase uncertainty. But with lower uncertainty is if you are a consumer defensive share, right? Like if you are Woolies, for example, you know, there's not a whole lot that's going to change the demand for going to buy groceries. So there are marginal things that could change that, right? We saw this during COVID when most people ate out. They went to Kohl's and Woolies instead. But that's an example where we'd have lower uncertainty. And then capital allocation is how do we think management has allocated capital into the company? What decisions have they made? So one of the things that, and once again, I took a chart from this, that our analysts do like is we do think that there's a pretty strong earnings recovery, particularly in telecom and media. So Southern Cross Media is obviously the media side of things. And then telecom, you can see there's a couple things that our analysts like, that 5G, of course, is increasing. And yes, that there will be this earnings recovery. So particularly around sort of roaming, right? So, you know, you go overseas and all of a sudden Telstra's charging you a lot more. All that stuff, of course, went away. And yeah, you can read what we thought about media as well. So consumer cyclical is an interesting one. So consumer cyclical, we have two different consumer categories, defensive and cyclical. So as I said, cyclical means that we are following the economic cycle. So think of these as purchases that are more choice. So a car is a perfect example, right? You can go buy a new car, or generally you can sit around and say, the economy's not doing very well. I'm going to try to keep my car for a couple more years. Versus consumer defensive, where you need to go buy food. At the end of the day, right? So you're going to go to Kohl's and Woolies no matter what, because you need to eat to survive. So those are purchases you're not going to curtail. Obviously, there could be some differences in sort of what you buy from a food perspective. But yeah, consumer cyclical, we in general think that a lot of these companies you saw big increases in their earnings, right? So during lockdown, basically what consumers did is they reclassified their earnings or their spending. So instead of going on trips and going out to dinner and everything else like that, they all went to Bunnings and did a reno, or they all went to JB Hi-Fi and bought a new television. We see obviously those spending patterns shifting back as people get out there more and go back to sort of what they traditionally were. So we think a lot of these earnings were inflated, and we think that the share prices are inflated based on those. The other thing that our analysts have talked about, and I use Amazon. Amazon's on our best ideas list, obviously trading in the US, is that we think it's kind of been underappreciated how well Amazon is doing in Australia. And you can sort of see, you can see by 2030, we think that Amazon will be a quarter of Australian online retail sales, or 5% of the total Australian retail market. So obviously that's pretty significant, and they're taking that market share from local retailers. And then, yeah, our best idea is Invocare. So Invocare is a funeral home operator. But yeah, we've seen deaths decline, number one, because people are staying inside and staying healthier. And the other thing is, of course, for a lot of the time, you couldn't have funerals because there are restrictions on how many people could come to funerals, particularly in New South Wales and Victoria. So Invocare had a little bit of an earnings reduction, but we do still like it. So consumer defensive. So a couple things that I think are interesting and here that we'll cover briefly. Forget the names on here. We'll talk a little bit about, because I get a lot of questions about these supermarkets. So basically looking at Woolies and Coles. Now, a couple things to think about. I was very surprised. If you go and look at the valuations on Woolies and Coles, they're very high, which I always think is interesting because it is not a great business to be in at the end of the day. So they are both sort of high margin or low margin, high volume, low margin businesses. I mean, they're not making a lot on everything they sell. The other thing is that there isn't a lot of growth. So at the end of the day, you know, there is, of course, battling for market share, which they do pretty significantly. But how do they do that? All those commercials you see on TV, they're doing it by investing in a lot of infrastructure. Not great, right? A lot of competition. So I don't think it's a great business. Our analysts don't think it's a great business, yet they are trading at very high valuations, particularly because a lot of people sort of fled into those stocks, sort of fleeing to safety and consumer defensive when COVID hit. So a little bit interesting. And I think, you know, our analysts have some interesting things to say if you read the research reports talking about online supermarket sales and how much it's spiked and how they're even lower margin for these businesses and how many people have gotten very used to it. I certainly know people who had never ordered online and then, of course, did it during COVID. Not that COVID's over, but did it and haven't gone back. And so we're seeing a lot of that, and it's actually lowering margins, which I think is pretty interesting. All right, energy. Energy is a really interesting one. So if you remember back to those other slides, we think energy in general is very undervalued. I will say, to give our analysts a little bit of a pat in the back, they got a lot of stuff wrong too. Not a lot of stuff, some stuff wrong, but they've been really, really good with energy. So back when, if you remember what happened, oil prices like tanked in 2020 with COVID, and our analysts were always very bullish on the shares, and they come up a lot, and they think that there's room for them to run. So a lot of things are happening. Number one, there's a lot of sort of M&A activity, particularly in Australia. So you've seen all the stuff about like BHP getting rid of their oil and gas side of the business. And you've seen a lot of investment. So you've seen a lot of investment into construction and developing new sites. But yeah, we're pretty, so if you look at Woodside, Whitehaven's also on our best ideas list. So yes, they are a coal producer. Our analysts do not think coal is going anywhere for a little bit. So yeah, some interesting names there. All right, so financial services. So financial services is what I was talking about earlier, is obviously interest rates have a lot to do with financial services. So sort of where we're seeing right now is, as I said, this net interest margin, we've seen it come down. Yeah, sort of waiting for the RBA to start raising rates again. And those will be certainly passed on to people have borrowed money before, they'll be passed on to anyone who has deposited money. So Westpac is our favorite of the big four banks. So you can read about that. Healthcare. So healthcare, we have nothing in the Australian healthcare sector that we believe is undervalued. So you can see on here, sort of limited buying opportunities. Yeah, there aren't many on our best ideas list. I put Merck on there in the US as a best idea, but you can see what the other ones are, but there aren't any in Australia. Oh, skipped one. Industrials. So industrials is pretty interesting. So it can involve all sorts of different things. We certainly have transport. So Transurban owns all the toll roads, of course, it falls into industrials, logistics companies, et cetera. But I didn't update. Sorry, I did not update the ticker. Two Aussie names on there. So Brambles, of course, makes pallets to help sort of ship stuff around. So yeah, two Aussie names in industrials. So real estate's a really interesting one because real estate can generally involves a REIT, so a real estate investment trust. So that is a company that owns property. Falls into a number of different categories. So you can sort of see our viewpoint in different categories. So retail REITs. So we do believe that there'll be a pretty strong rebound. So obviously retail shopping, in-person retail shopping was hit during COVID. But yeah, looking globally, obviously we've seen a pretty big bounce back. We think the same thing will happen here. Office REITs. So the difference is that even though I think there are two other people in our office today, even though there's been low occupancy, people are continuing to pay the rent, and there's a lot of supply coming online in Australia. Building projects, even, we're in Barangaroo in Sydney. There are projects all over the place. You walk around downtown, the CBD in Sydney, there are a lot of office buildings, stuff that was started before COVID. So it'll be interesting to see. We've heard about all of these return to work and everything else. So should be interesting. And then, yeah, industrial is another category. So Lend-Lease is on that Global Best Ideas list in Australia. Ventus is a US company that runs senior living, owns a real estate and senior living. And then finally, technology. So technology is a pretty small part of the Aussie market. So a lot of sort of the companies that are considered technology, Afterpay and things like that, which obviously have not done well, and Afterpay was acquired. But yeah, fall in different categories. But yeah, this is, once again, we're sort of looking at valuations and what would happen in higher interest rates. So we talked about that before, what the impact would be on growth stocks. And then finally, utilities. So yeah, utilities, I think most people know what they are. They refine oil and gas, they generate electricity, etc. Or sorry, I did not. This is my fault. That is energy. Anyway, AGL is on our list. We're actually arranging something, hopefully in a couple of weeks, where we will have the AGL CEO on, and our analyst Adrian will interview him. All right. So sorry, I threw that in very late. I know this thing has been going on for a while. So either there's any more questions that I can quickly answer. Yeah, so we've got a question. We have access to these slides post-call. Yeah, I'll put together an email tomorrow for everyone who registered for this. Send those slides through, and I'll send some links to some of the different things that I referenced. And what else do we have? Please comment on Morningstar's current star rating. Okay, so let me talk quickly, Joseph, about the star rating. So basically, I'm very focused, obviously, when I talk about this, on the fair value. That's where analysts spend their time doing, calculating a fair value. We then compare that fair value to the market price, and that translates into a star rating. So a star rating of 5 stars means it is the biggest discount between what something's trading for and what we think it's worth. So those would be the cheapest shares. 1 star would be something we think would be very overvalued. Now, the one thing that factors into that is the margin of safety. So the margin of safety is a famous term coined by Ben Graham, sort of the father of investing, who wrote The Intelligent Investor and Security Analysis. And margin of safety just refers to the fact that just because you estimate the price or something, it doesn't mean you're going to go out and buy it for a couple cents less than that, because you want to account for a couple things. Number one, that the future is unknowable. And number two, that the perceived perception in analyst models isn't really there, because this is an estimate of the future, right? So we want to have a gap between what we think something's worth and what we would actually pay for it. So that's margin of safety. So basically, higher uncertainty stocks have a bigger margin of safety. So basically, it means it would take a bigger discount to hit our 5-star rating. So hopefully that answered your question. All right, so we've got a couple more, but I am cognizant. I am cognizant that we have been on here. So if you have any questions, just email them to me directly. It's mark.lamonica1@morningstar.com. I'm going to run home, but I'll get on email after that. And yeah, let me know if you have any questions. And yeah, we'll have, the other thing is I'll include a link to, so somebody asked, sorry, I missed some of the chat. Somebody asked, yeah, somebody asked if they could see the recording, so I'll send through the recording as well. So anyway, thank you guys. I appreciate you joining. Hopefully this was somewhat interesting. And thank you for all the nice messages people are sending. I appreciate that. All right. Thanks, guys.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.